Welcome back, Cyber Guardians. Today we will be discussing the IRS Dirty Dozen, including the worst of the worst tax scams. Compiled annually, the Dirty Dozen lists a variety of common scams that taxpayers may encounter anytime, but many of these schemes peak during filing season as people prepare their returns or hire someone to help with their taxes. 1. IRS kicks off their annual Dirty Dozen with a warning about phishing and smishing scams. Phishing is an email sent by fraudsters claiming to come from the IRS. The email lures the victims into the scam with a variety of ruses, such as enticing victims with a phony tax refund or threatening them with false legal or criminal charges for tax fraud. Smishing is a text or smartphone SMS message where scammers often use alarming language such as, "Your account has now been put on hold," or "Unusual activity report," with a bogus solutions link to restore the recipient's account. 2. Bogus tax avoidance strategy schemes with an international element. Various fraudulent schemes threatening taxpayers can take different forms, including exploitative agreements related to syndicated conservation easements and micro-captive insurance arrangements. These schemes may also have an international aspect, such as concealing money and digital assets in foreign accounts or using foreign captive insurance and Maltese foreign individual retirement accounts. Promoters are syndicating conservation easement transactions that purport to give an investor the opportunity to claim charitable contribution deductions and corresponding tax savings that significantly exceed the amount the investor invested. These abusive arrangements, which generate high fees for promoters, attempt to game the tax system with grossly inflated tax deductions. Also called a small captive, a micro-captive is an insurance company whose owners elect to be taxed on the captive's investment income only. Abusive micro-captives involve schemes that lack many of the attributes of legitimate insurance. These structures often include implausible risks, failure to match genuine business needs, and in many cases, unnecessary duplication of the taxpayer's commercial coverages. In addition, the premiums paid under these arrangements are often excessive, reflecting non-arm's length pricing. Schemes involving international elements include Maltese retirement arrangements and digital assets. Unscrupulous promoters continue to lure U.S. persons into placing their assets in offshore accounts and structures, saying they are out of reach of the IRS. These assertions are not true. The IRS can identify and track anonymous transactions of foreign financial accounts. 3. High-income filers vulnerable to illegal tax schemes face risk from improper art donation deductions, charitable remainder annuity trusts, and monetized installment sales. Those with high incomes can be tempting targets for a variety of schemes and aggressive tax strategies designed to reduce taxes. These can take many different forms, ranging from inflated art donation deductions to aggressive charitable remainder annuity trusts and detailed shelters that maneuver to delay paying gains on property. To quote IRS Commissioner Danny Werfel, taxpayers should be extra careful on tax maneuvers that seem too good to be true. Beware of advertisements for seemingly ideal tax structures that distort tax laws and leave victims with civil or criminal tax penalties. 4. IRS warns tax pros and businesses to be cautious of ongoing spearphishing attacks to gain sensitive information. Warns of surge in new client scams. While phishing refers to emails or text messages designed to steal personal information directly, or by clicking on an embedded link or attachment. Spearphishing is more targeted. Spearphishing is a type of phishing that targets specific individuals, organizations, or businesses, typically using malicious emails. To avoid being a victim of spearphishing, never click suspicious links or download attachments from unknown senders, including potential clients. Call the potential client to confirm the email is from them. Send only password-protected and encrypted documents through email. Protect email accounts with strong passwords and two-factor authentication. Use security software products with anti-phishing tools. Be vigilant year-round, not just during tax filing season. 5. Taking tax advice on social media can be bad news for taxpayers. Inaccurate or misleading tax information circulating. Social media can routinely circulate inaccurate or misleading tax information, where people on TikTok and other social media platforms share wildly inaccurate tax advice. Some involve urging people to misuse common tax documents like Form W-2, or more obscure ones like Form 8944 involving a technical e-file form not commonly used by taxpayers. Both schemes encourage people to submit false, inaccurate information in hopes of getting a refund. 6. IRS urges taxpayers to not fall prey to untrustworthy tax preparers. Ghost preparers can disappear with taxpayer cash and personal information. A common problem seen annually during tax season, ghost preparers, pop up to encourage taxpayers to take advantage of tax credits and benefits for which they don't qualify. These preparers can charge a large percentage fee of the refund or even steal the entire tax refund. After the tax return is prepared, these ghost preparers can simply disappear, leaving well-meaning taxpayers to deal with the consequences. 7. IRS warns about fake charities exploiting taxpayer generosity. In natural disasters and other tragic events, it's common for compassionate individuals to donate money to help the victims. Unfortunately, scammers often use fake charities as a cover to not only obtain money but also gather sensitive personal and financial information that can be exploited for tax-related identity fraud. 8. Beware of offer in compromise, OIC Mills, that falsely claim their services are necessary to resolve IRS debt. The OIC is a valuable IRS program to help taxpayers who cannot pay their federal tax debts, and some companies offer legitimate services. But the IRS encourages individuals to take a few minutes to assess the information available on irs.gov to determine if they meet the eligibility criteria for the OIC program and to avoid hiring expensive promoters. Taxpayers need to be cautious with aggressive marketing around the offer in compromise program that can mislead taxpayers. These mills try to pull in steep fees while raising false expectations and exploiting vulnerable individuals with promises that tax debt can magically disappear. 9. IRS warns about false fuel tax credit claims. Taxpayers should be wary of scammers. Heightened review. The fuel tax credit is available only for off-highway business and farming use and not for most taxpayers. But the IRS continues to see instances where unscrupulous promoters or return preparers mislead taxpayers about fuel use and create fictitious documents or receipts for fuel. 10. IRS warns taxpayers to stay away from helpful scammers offering to set up an online account. The goal for these criminals is getting personal tax and financial information that can be used to commit identity theft. The IRS online account is a tool that provides convenient access to an individual's tax information. The information is also valuable to identity thieves who use it to submit fraudulent tax returns in a victim's name to get a big refund. 11. Beware of aggressive promoters who dupe taxpayers into making questionable employee retention credit claims. Risks continue for small businesses. Special withdrawal program remains available. When properly claimed, the ERC is a refundable tax credit designed for businesses that continued paying employees during the COVID-19 pandemic while their business operations were either fully or partially suspended due to a government order, or had a decline or significant decline in gross receipts during the eligibility periods. The IRS warns businesses and others to stay clear of unscrupulous and aggressive promoters of questionable claims for the Employee Retention Credit, ERC. These questionable ERC claims often put unsuspecting businesses and other entities in jeopardy of penalties, interest and potentially even criminal prosecution for claiming the ERC when they don't qualify and aren't entitled to it. Thanks for watching and remember to like and subscribe for more cyber wisdom.